When it comes to inheritance and estate planning, navigating the numerous tax implications in Canada can be a daunting task. To make the process smoother, it is important for individuals to understand the country's inheritance tax system and estate planning legislation. This comprehensive guide will provide valuable insight into the tax implications of inheritance and estate planning in Canada, ensuring that you can make informed decisions for both yourself and your loved ones. Unlike many other countries, Canada does not impose an inheritance tax on beneficiaries. Instead, the Canadian tax system treats the estate as a separate legal entity, responsible for any taxes owing upon the death of an individual. The estate is subject to taxes on any income earned during the administration period, as well as any capital gains resulting from deemed dispositions of the deceased's assets. Upon death, a person is considered to have sold all of their capital property at fair market value. This is referred to as a deemed disposition, and the resulting capital gains are subject to tax. Half of the capital gain is taxable, known as the taxable capital gain. This tax will be paid by the deceased's estate before any assets are distributed to beneficiaries. There are, however, a few notable exceptions. Spousal rollover. A person can transfer their assets to their spouse or common law partner tax-free, and taxes on capital gains will only apply when the surviving partner eventually sells the property or passes away. Principal residence exemption. If the deceased lived in their primary residence for a significant portion of the time they owned it, they may be eligible to claim the principal residence exemption, which can prevent or reduce capital gains taxes on the home's disposition. Lifetime capital gains exemption. Individuals can also use their lifetime capital gains exemption to minimize taxes on the deemed disposition of their qualified small business corporation shares or qualified farm property. In the year of death, the deceased person's estate must file a final tax return, which includes any taxable income earned up until their date of passing. Following the final tax return, the estate becomes a separate taxpayer, and it is responsible for any taxes owed on income earned during the administration period, i.e., from the date of death to the date when all assets are distributed to beneficiaries. It is important to note that a graduated tax rate is applied to the income earned by the trust, rather than the flat top tax rate applied to most trusts. Registered Retirement Savings Plans, RRSPs, and Registered Retirement Income Funds, RRIFs, are subject to specific tax rules upon death. Ordinarily, the fair market value of these plans is included in the deceased's income, and taxes are payable by their estate. However, there are some tax deferral options. Spousal rollover. Transferring the RRSP or RRIF to the surviving spouse or common law partner can defer taxes until the surviving partner withdraws funds from the plan. Income splitting. Couples can allocate up to 50% of eligible pension income to their spouse or common law partner, potentially reducing the overall tax liability. Probate is the legal process of validating a deceased person's will and mortgage administrator to manage their estate. While probate fees vary by province, they are generally calculated as a percentage of the total value of the estate, including real estate, investments, and personal property. In some provinces, these fees are referred to as estate administration taxes. As probate fees can be significant, it is recommended to have a sound estate plan that can minimize probate costs for your beneficiaries. Estate planning involves several strategies to minimize taxes while ensuring your assets are distributed to your beneficiaries in accordance with your wishes. Here are a few common techniques. Gifting assets to loved ones during your lifetime, as long as the assets are not subject to capital gains taxes. Designating beneficiaries on your insurance policies, RRSPs, RRIFs, and tax-free savings accounts, TFSAs, to bypass probate. Setting up joint ownership of assets with a right of survivorship with the intended beneficiary. Establishing a testamentary trust to hold and manage assets for specific beneficiaries. Keep in mind that it is crucial to review your estate plan periodically and to work with a professional advisor, such as a financial planner, accountant, or lawyer, to ensure your strategy is up to date and legally compliant.